Hi, my name's Amanda and welcome to the September Quarterly Market Update. Today I'm joined by Hugo and Jeffrey and we'll be covering the economic and investment factors that have been affecting the markets over the past quarter. So first of all, let's start with how the market performed. So despite the ongoing geopolitical conflicts and trade tensions, the markets actually performed quite well. So Jeffrey, can you provide some colour around what performed and what were the key drivers?
Equity markets had a very strong quarter. If we were to reflect in the US market, the big indices pushed higher, which supported growth in tech and AI sectors in the US. You come back home, we reflect on the Australian market, it's somewhat a similar sort of story. We had key economic data, which was better than expected, which came out in the last quarter. We looked at the inflation numbers, it's at 3% at the moment, which is the top end of the RBA inflation target, but we can see clear signs of that softening. Another thing what worked out really well in the last quarter was the RBA and Fed cutting interest rate. That was pretty much a tailwind for equity, the risk assets for the, supported the growth of equity market. The other thing when we look at is the trade agreements that actually boosted consumer sentiment because of a progression made on the key trade agreements. So that all of that put together, which actually provided a very strong quarter for globally and in Australia. The focus was fundamentally, the interest rate environment contributed to that, inflation contributed to that, and also, the earnings of the big, companies which contributed to performance of the quarter. And
on the flip side of those positive stories, we've seen trade and tariff policies really bringing uncertainty, continue to bring uncertainty. So Hugo, what are you seeing, how that's affecting the economy at the moment?
Yeah, sure thing. So obviously we had Liberation Day, those huge tariffs that were enacted on all those nations, but we've actually had quite a few trade deals get done since then. And at the end of August, there was an agreement between the US and China, US and Europe, and US and other major trading partners. And investors have gained a lot of confidence in that certainty around the new tariff regime. They're not really focusing on the level that we've gone from an effective tariff rate of 2 to 3% up to around 17.5%. But they're now focusing on the fact that we have certainty around the new tariff environment. Corporates and their management teams can now, go out and run their businesses knowing the new environment. There's still plenty to play out, we think, in that story. So obviously the Supreme Court rules on whether Trump is using his powers correctly by enacting those tariffs. And so we do think early 2026, this is going to continue to create some uncertainty in markets. But at the moment, investors seem pretty happy with the status quo.
And on the topic of the US government, so currently the US government is in shutdown, has been since the 1st of October. And at the time of this filming, it continues to be in shutdown because they've yet to reach an agreement in Congress. So Jeffrey, what does that mean for investors, a US shutdown, government shutdown?
Look, we are in the midst of a full US government shutdown. It's because of Congress failing to pass their funding bill. What this means is there's about 800,000 federal American employees. They'll probably be sent home on unpaid leave until the funding restores in the government. However, though, if we do look at historically since 1970s, if you look at the US government, they had 22 shutdowns. On average, the shutdown, the duration of the shutdown, on average, we look at it's been like 8 days. Most of the time it's been partial. Markets have tend to look past that. But in this instance, if it is a full shutdown, if it is going on for a prolonged time, it may have an impact on the global market. So some estimates suggest that it might shave off a weekly shutdown, might shave off 0.1% of the US GDP. So it is something to watch. However, though, it signals more head noise than actually a signal for market downturn. When we look at a long-term portfolio, this all seems to be quite noise at the moment.
Yeah, a lot of geopolitical risks just this year. You think of rising public debt levels, the tariff bonanza we had. We've had the fifth prime minister over in France under Macron. So lots of geopolitical risks, wars as well. But investors look through this a lot of the time and very long term. So we certainly don't recommend any actions or short term reactions to the recent US government shutdown.
But something that has been creating a lot of noise, and maybe something even more, is the AI sector. So we constantly hear about earnings growth being massive, and it's been the trend for quite some time now, including the talk of bubbles, AI bubbles, but we just keep seeing this growth. So what are you seeing in the sector now, Hugo?
Is it a bubble? Isn't it a bubble? Nobody knows necessarily, but certainly some pretty frothy valuations concentrated in the Magnificent Seven stocks. But interestingly as well, anything really AI linked at the moment is receiving a strong bid. So the best performer this year in equity markets has been no revenue and unprofitable companies in the NASDAQ, which is a tech-heavy indice over in the US. But they've done, companies with no revenues in that indices have done 35% or more on average. So normally those companies you wouldn't want to invest in, but if they're AI linked or have some connection to the AI theme, they're receiving a really strong bid. So something that we've been watching as an investment team, which has been a bit concerning, is the circular nature of the AI ecosystem at the moment. So you've got NVIDIA investing $100 billion into OpenAI. OpenAI saying they'll turn around and buy $100 billion worth of NVIDIA chips to put in those data warehouses. You've got a deal between Oracle and AI as well, to the tune of $300 billion. So it does seem a very circular, and if you do see a slowdown in the capital expenditure of these firms, or one of those firms pulls back and says, hey, we actually don't need as many NVIDIA chips to train our AI models on, could unravel a little bit. So it's something we're watching closely. The expectations are high, and we'd say that that pocket of the market is priced to perfection. However, saying when it might unravel or how long it could continue is a really difficult question to answer.
Yeah, it'd be interesting to see whether these companies can keep up with what everyone's expecting of them.
Exactly.
In terms of labour markets, so the dynamics of the labour markets is something that the central banks follow closely in order to determine their monetary policy. So what have you seen, Hugo, throughout this quarter of labour markets here and in the US?
Yeah, so domestically, the labour market is pretty tight at the moment. So unemployment's sitting around 4.2%. And the RBA called it out in its most recent press conference, Michelle Bullock, that really the labour market remains a little tight. So this is putting pressure on wage price inflation. So that came in most recently at 3.6%, which is concerning for people who are wanting rate cuts because it does place upwards pressure on inflation, particularly services inflation. So we have seen the RBA bring rates down from 4.35% down to 3.6%. But potentially it might be very close or already at the end of the cutting cycle if the labour market continues to stay so tight. It's been a bit of a different story throughout the quarter with the US. We have seen some pretty weak non-farm payrolls numbers, job growth is low. We haven't seen any firings just yet en masse, but we have seen a lower rate of hiring. So it's something that we're watching closely and certainly something the US Federal Reserve is a bit concerned about given that they cut rates 2 times throughout the quarter, and it's something they noted as well in their press conference.
Mm-hmm. And speaking of interest rates here, the RBA has cut 3 times already this year, which is great news for those who may have a mortgage. But what about for those who rely on income that's based on these interest rates? What do you see here, and how are you positioning portfolios, Jeffrey?
So the RBA, as going back to what Hugo mentioned as well, RBA has cut rates is down from 4.35 to 3.6, which is a response to the inflation, moderating the inflation numbers. It is some key implications for income investors and retirees in this stage. Interest rates have come down. If you look at term deposits and cash product yields, interest rates have come down from the highest high. However, it still relatively remains attractive for income investors and retirees. So for an example, if you look at a term deposit, rates are not high, but still relatively it is attractive. So there is opportunity. In terms of portfolio construction, if I were to answer that, typically a retiree, we would look at doing a well-diversified approach. So a balanced portfolio would consist of high quality fixed income and cash products, which is provide the retirees stability and also capital preservation. And then we'll look at about allocating 70% into good quality equities and property. It'll future-proof their portfolio against inflation, provide them capital growth, and also some good tax-effective income through franking credits. One of the main concerns in a retiree's portfolio, Amanda, is cash flow risk. So this is a retiree, not having enough income to meet their lifestyle needs in a low interest rate market or when the market's really volatile. So a balanced portfolio in this instance at 30%, the defensive allocation I was talking about works perfectly well so that they're not taking out funds out of the growth assets in the wrong time. So that'll actually provide a much more comfort for a retiree ensuring their income is secure.
Unfortunately, we're out of time today, so thank you very much, Hugo and Jeffrey, for your commentary and your insights. And thank you today for tuning in. We are releasing a more detailed report on what we were talking about today, so please look out for that. In the meantime, take care and thank you.